Welcome to today's show. This is Christopher Calandra, your host of the Simply Financial podcast. This is episode number 16 of season number 4. Today's investor update is going to have a couple of different parts. The agenda is to do an investor update, talk about some planning ideas and strategies, and if time allows, and I believe it will, we'll do some question and answer at the end. I want to make sure I get through the material for everyone, so we'll just do the questions at the end, again, assuming time allows, which I'm pretty sure that we can do. So first off, we came across this quote from Ralph Waldo Emerson: "The first wealth is health," and given this unprecedented period this country is, the world is in, it's an important quote. Money is important, and we're going to talk about the markets and money here today, including some tax strategy. But we always know that health is the most important thing, and this episode, this pandemic, only reinforces what we already knew and maybe sometimes overlook or even forget. But I thought that was kind of an appropriate way to start the presentation. Additionally, I want to reinforce that I'm a certified financial planner. We're a wealth management financial planning firm, and so we focus on 5 key areas of financial planning: preservation planning, retirement planning, tax planning, estate planning, and investment planning. And today's presentation is going to focus more on the equity markets and the overall economy, but as a comprehensive wealth management firm, we try to always consider the impact of any recommendation, not just in one area, but in all of these areas for our clients. And many people that are attending today, and there's pleasantly a large number of people in attendance. Some of you are clients, some of you are not, but keep in mind, when we're working with a plan for you, we want to take into account these areas of financial planning. It's not just about investments, it's also about the other 4 that are on the list, and we're always cognizant of that in our work with clients and all of the planning we do. So let's begin the equity market review. 2019 was a healthy year for investors. It was a great year. The U.S. economy continued its winning streak. We were in the 10th year of the bull market that began after the Great Recession that lasted from 2008 into early 2009. And one of the things that I spoke about, this will come up again in a few slides, a lot in 2019, even going back into 2018, and it was talked about a lot before this pandemic in 2020, is that the U.S. economy was strong, and one of the things that was bolstering the U.S. economy was a very good unemployment picture. And so 2019 was a very good year. There was optimism in the early stages of 2020 as it appeared that the U.S. economy was accelerating, and unemployment continued to be very low and jobs numbers very strong. And things changed, as we all know, dramatically. And so the equity markets reacted to the pandemic and all of the economic damage that was being done. So in mid-February, the markets made new all-time highs and then changed. This silent but deadly virus quickly decimated an 11-year bull market. It was amazing and is amazing how quickly everything turned seemingly on a dime. So after the strong year in 2019, in less than 3 weeks, the S&P 500 fell from a 52-week high to a 52-week low. This quick waterfall of the equity markets has set many records. We've had an unbelievable amount of volatility. Most days for several weeks now have seen plus or minus 1% moves very consistently. That is very abnormal. Looking at the market over a very long period of time, you typically do not see such volatility, but we're going to use the term unprecedented a lot in this discussion, and probably when you discuss things with your family, friends, coworkers, the word unprecedented comes up a lot. We are certainly in unprecedented times. So this unexpected period, it seems like the economic outlook is evolving daily, and that's leading to a lot of the volatility. There's so much going on. There's so much fluidity, not just with the pandemic and the healthcare crisis, but also what's happening in the economy. So let's talk a little bit about knowledge being power. We believe here at Elliott Wealth Management, I believe this, the whole team believes, that an educated client is our best client. When we meet with our clients, and hopefully if you're a client and you're listening, you can attest to this, we want to educate our clients. Our clients do not want to become experts like we are. They don't necessarily want to be immersed in tax planning and retirement planning and the history of the markets, but being educated is a very powerful way to help make good decisions. So let's examine some of the data I want to share with you this morning. I mentioned this before. We were in an 11-year bull market that began in the early days of President Obama's administration way back in 2009, and that bull market was uninterrupted for 11 years. As we entered into 2020, it looked like the bull market was intact. As I mentioned before, and I'll probably mention again, the U.S. economy was actually accelerating, not decelerating, and we were creating jobs every month, and we had done so for over 10 years. And what I had said repeatedly to clients was that if the U.S. economy is growing, and even better if it's accelerating, and the economy continues to create jobs, the bull market is likely to continue. It would have been hard for me to envision us getting to a recession or into a bear market or a sustained sell-off in the market in the face of so much job creation and such a strong economy. A bear market, by the way, is defined when the market falls at least 20% or more from its 52-week high. So we had a bear market. One of the questions is, did we already give birth to a new bull market? Because the bear market fell 20%. We had the market fall more than 20%. We've seen it rebound and come back some, has not gone back to where it was at the beginning of the year or the February highs, but it has rallied here the last couple of weeks. And one of the key questions is, did we already give birth to the next bull market, or are we still in a bear market and we had a rally within a more prevalent bear market? That's a key question that will be answered over the coming weeks and months. Since entering the bear market, as of early April, we've had this bounce back in equity markets. So that is the good news, and there are encouraging signs. However, there's lots of change going on and a lot of uncertainty in the economy, in the markets, and in healthcare, where we're still trying to deal with the pandemic. So the next thing I wanted to talk a little bit about is some definitions related to bear markets. There's three types of bear markets. They're structural, cyclical, and event-driven. Structural bear markets are those created by imbalances and financial bubbles. They're very often followed by a price shock, such as deflation. This is what happened in the Great Depression in 1929. It was also a structural bear market in 2008 when the U.S. financial system was in deep, deep trouble. A cyclical bear market are ones that are typically a function of the economic cycle, often marked by rising interest rates, impending recessions, and falls in corporate profits. And then the third type is event-driven bear markets. And these bear markets are created by events such as war, perhaps an oil price shock, an emerging markets crisis, things like that. We are in an event-driven bear market, which arrived on the scene due to the sudden viral pandemic, coronavirus or COVID-19. You could use the term that you prefer. Event-driven bear markets, they're the hardest, if not the most impossible to forecast and to navigate through. This is incredibly difficult stuff. COVID-19 created the first of its kind bear market, one that was caused wholly by the virus. The economy was doing well. Unemployment was doing well. Consumer confidence was high. U.S. companies were very competitive as they competed for business, not just in the U.S., but worldwide. But now we're in this event-driven bear market, the first of its kind, unprecedented. There's that word again. One fact that I wanted to bring to your attention is that interest rates have gone down to virtually zero. So the quick history on that is the federal funds rate, controlled by the Federal Reserve, was cut by 0.5 point or 50 basis points, bringing it down to a range of 1 to 1.25 early on in the crisis. But then, as a response to the increasing risks of the coronavirus and as the outbreak was accelerating, the Federal Reserve took an enormous step and cut its benchmark interest rate by a full 1%, bringing the range down to 0 to 0.25% or 0.25%, so virtually zero. When the Fed first started reducing interest rates, the consensus was, most experts thought that the central bank was catching up to where the markets were headed. Now, where we sit today, it seems that the Federal Reserve is responding to both the economy and also the fact that the 10-year Treasury, which is an important benchmark, had fallen to all-time lows. The Treasury rates on the 10-year is around 55 basis points now, or a little over 0.5%. That's incredibly low. I mean, it's hard to fathom that this is where 10-year Treasury rates are. Rates have been low for a long time. The trend originally started back in the early 1980s, in the early days of President Reagan's administration, but that trend accelerated after 9/11 as the Federal Reserve cut interest rates to help the economy after the attacks. And after 2008, again, the Federal Reserve aggressively cut interest rates. They then increased them a bit in the interim, only to return to cutting, and now aggressively cutting once again, bringing them close to zero. The only other time they were this low was briefly during the financial crisis in 2008. I also want to talk just a little bit about oil prices. They've been in the news quite a bit, but with all that's going on with healthcare, with the closure of businesses and stay-at-home orders throughout the United States, as if things were not bad enough, we have an oil price war between Saudi Arabia and Russia. Now, typically, this would have commanded a lot of headlines and a lot of discussion, but it's been overlooked because of all the other problems and chaos that we are dealing with. But this price war between Saudi and Arabia emerged around March 7th, and it decimated the energy industry. Oil prices, energy prices were already on the decline because with the U.S. economy and many worldwide economies shut down or slowing their economic output, demand for oil was already on decline. Then you had this price war and oil dropped off significantly. Oil prices saw the worst month and worst quarter in history, and that was through March 31st. What we've seen so far in April is another leg down as there is too much oil sloshing around relative